Hello everyone, and there's been a lot happening of late, most of which has been a very big and strong rally in equity markets. And as most of you will know, I'm pretty much a bear overall still. I have been since the start of the year. One of the major buy reasons I'm hearing from my friends in the funds management industry, the hedge fund managers, is that Clifford, 2020, COVID proved that if bond yields are rolling over, it's good for the market. So they see a recession in the United States as actually being positive US equity markets. Now that's an interesting idea and concept, and they make it sound all very complex, but that's about it. The reality though is that back then you had massive government stimulus measures in place, you had quantitative easing from central banks, and you had crisis historic low interest rate settings. None of those things are in place at the moment, and I think they were the major drivers of the equity market. But people are so keen to have an excuse to buy the market. So the herd is definitely long. The herd is definitely buying, and I've been trying to stand in front of a freight train of late in trying to pick the top and sell, but I've been doing that again in the last 24 hours of my personal trading. So I am bearish stocks, and I do see the price action as perhaps at last starting to support my bearish view. Now on the economics and the fundamental front, we've been nothing but spectacularly accurate. We said a year ago that the Fed, the RBA would be raising interest rates too late. Inflation wasn't transitory, that it was going to run away like a horse out of a gate, and that's exactly what's happened. And that then in the end, the Fed and the RBA and other central banks would make the second mistake of belatedly hiking rates too aggressively, which they will feel the need to, of course, to head off inflation. The problem is, historically, inflation is caused by overheated economies with extreme demand, whereas in the current environment, the inflation is now caused, first of all, we had kind of what you could call good inflation. Now we're having bad inflation. The good inflation on the equity front, not for the economy and for most people out there in the working world, but for stock valuations, the good stock earnings, the good inflation was coming from that out of the melee of COVID and the supply chain disruption, people from the corner store to the global corporation could raise their prices without losing market share. So it was that profit margin fattening that was a major contributor to the previous period of inflation. But of course, we all know things have changed this year. Further ongoing supply chain disruption, COVID related, particularly lockdowns in China, but also the loss of supply for an extended period and probably ongoing in a sort of dislocating way out of Ukraine and also out of Russia, because a lot of the big shipping companies just refuse to visit Russian ports anymore. And then there's the sanctions. So there's the loss of supply and there's the refusal of supply. So all of these things are adding tremendous upsurge, as we all know, to food and energy prices. A lot of people are again trying to suggest that this kind of inflation, they haven't used the word transitory this time because they got it so wrong using that word last time, but they are now again saying inflation could be peaking. These tend to be the people who said inflation was peaking at 5.4%. I remember the media headlines back there, all very enthusiastic about the notion that inflation has now peaked after this surprise move to 5.4%. It was 5.4%, I think, or 5.3% the following month. And they went, oh, inflation's peaked. And I said, no, it hasn't. It's going a lot higher. And even at 9.1%, I can say to you that US inflation has not peaked. It's going a lot higher. I remember around 6-7%, I said inflation could go to 10% this year, maybe even overshoot to 12% momentarily. But certainly for the moment it is going higher. The Federal Reserve recognizes this. Now, I'm not sure where the market got this idea that it could second guess that the Federal Reserve is going to slow interest rate hikes or even cut interest rates next year because of the slowing economy. All the way along the path, well, since they realized it wasn't transitory and they had to do something, since then, Powell and most Fed presidents, and we've had 3 Fed presidents reinforce this in the last 24 to 36 hours, they will accept some economic pain. The thing is, they don't realize how much pain is actually out there. but they will accept some economic pain as it presents itself in the data, but in the real world it's far worse, of course. But as it presents itself belatedly in the data, they will accept economic pain and continue focusing. Number one enemy, inflation. Hit it, hit it, hit it with a sledgehammer called higher interest rates. So no, weak economic data is not a reason to buy stocks, but the whole world thought so, particularly Wall Street during the week, during last week and the last few days. And they've basically, a recession in the US, which I think we're among the first house in the world to forecast, a recession in the US is now in place. We've had 2 negative quarters of growth. That last second quarter number, you've got to remember the market was expecting a 0.5% gain. It got a 0.9% contraction. Big difference to expectations. Market was very volatile on the day and then went higher. I think the whole world who wants to buy on this nonsense idea that a weakening economy means lower yields, bond rates, and therefore the Fed eventually having to stop hiking and cut rates, it's all a fairy tale nonsense to simply support the emotional desire to again be buying like in COVID. That's what's happening. Human beings respond to recency, frequency, intensity. That's how their brains are working. That's how all our brains work. And that's what they're doing. So I think the whole world is long and wrong at this point, and I'm happy to be fading that. And speaking about fading markets, I think you have to fade the faders. I mean, in the 80s and the 90s, we knew to, when there was bad news, perhaps buy, and when there was good news, perhaps sell. But we're in the minority then, whereas there's been plenty written about it in the tens, and the zeros in the tens. And so now the whole world thinks it's very, very clever if it does exactly that. Buy the rumor, sell the fact, that sort of thing. Or sell the rumor, buy the fact, has been the case with interest rates and weakening US economic growth of late. So because everyone's doing it, you need to do the other thing. So you have to fade the faders. So that's my big trading methodology tip for the coming months, perhaps the rest of this year. Overall though, economic dire bedlam out there. Seriously, manufacturing is slowing around the world. I've kept highlighting for some time now that in 1929, manufacturing was slowing dramatically long before the stock market really fell away. And there are little warning signs of that sort of thing happening again. But I do think the United States is well and truly already in recession. It's going to be a long, hard slog for the US economy. There is no sharp rebound in sight. Europe is about to go into recession. And don't look at the employment data. The employment data just says, particularly for countries like Australia, it just says immigration is basically stopped. And travelers who were temporary workers or semi-permanent workers are in short supply. That's why there's full employment. It doesn't reflect the actual on the ground what's happening in the economy at all. Speaking of Australia, we've recently seen both manufacturing and services PMI indicators begin to roll over rather badly. And I think these are very powerful warning signs for the Australian economy. Do not look at the employment data. And if you take the employment data out of the picture, all the other data in Australia is starting to roll over rather badly, as we've warned of for quite some time. So hold on to your hats. I could be wrong. The equity market could have started another 2020 COVID miracle, but there's no historic low interest rates. They're going up. There's no government stimulus. It's been overdone, and now there's a hangover effect in the economy. There's still supply disruption. Just be very careful here. I would say on the day, we're looking at, over the next couple of days, opportunities for the market to rally, but I'm very suspect of the sustainability of those rallies. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities.